In this video, I am going to talk to you about how you can go about estimating an investment's cash flows. This is a very, very important topic. Whether you are an individual or whether you are a business, at some point you're going to be making some sort of a long-term investment. In other words, an investment that you expect to generate cash flows for you over a long period of time. So as a business, you might be investing in a piece of machinery. If you run a restaurant, for example, you may be looking to invest in a van that can help you with your catering business. If you're an individual, you may be looking to buy an investment property or invest in your MBA, which is an investment in human capital, right? So that's an investment that you expect to generate incremental salary or extra cash flows for you for a long period of time. And so regardless of whether you're an individual or a business, you want to understand, is the investment that I'm making in this long-term asset, is it worthwhile? So in order to put this in perspective, recall that there are different ways in which you can determine whether an investment is worthwhile or not. There's something called a payback period, which simply says, look, figure out how quickly an investment is paying you back on the initial set of investment that you made. There's something called the net present value, which says discount all the cash flows that you're going to get from an investment at your required rate of return. Then there's something called an internal rate of return. There's even something called the profitability index. The objective of this video is not to give you a rundown on these different metrics. This is something that I've talked about in a previous set of videos. But the main point here is that regardless of which metric you are using to evaluate an investment, you need to figure out how much cash flow is going to result from it. Now, before we continue this discussion, it is important to be wary of some of the jargon that you're going to see out there. When we say an investment's cash flows, what we are typically referring to are its free cash flows. So sometimes you'll hear the term FCF, which stands for free cash flows. Sometimes these are also known as an investment's financial cash flows. In fact, sometimes you may even hear the term unlevered cash flows. What are the investment's unlevered cash flows? There's a reason why they're called that. Not important right now, but the main point here is that they're all different ways of saying the same thing. When we say what are an investment's cash flows, we are typically referring to its free cash flows. Free, what does it mean to be free in this case? Well, here free means that this is the cash flow that we're expecting the investment to generate that is then free to be distributed to people who provided the funding for that investment. Let me try and explain. Let's say that you are a proud owner of a restaurant, okay, and you're looking to make an investment in an asset, which is like a 3-door big refrigerator in which you're going to be holding some of your inventory, maybe some of your semi-finished products. And so you're thinking, okay, is this investment worthwhile? So what you're interested in is the cash flow that is going to result from this investment in an asset at time period 0, maybe at time period 1, at time period 2, so on and so forth. And what I'm trying to say here is that when we're trying to measure these cash flows, we're trying to calculate free cash flows. In other words, those cash flows that will result from this investment that are then free to be distributed back to the people that provided the funding for this investment. So, for example, some of the funding for this refrigerator may have come in the form of bank debt. And in that case, you owe some interest expense to the bank, and you might be interested in making some principal repayments, so principal repayments, okay? And so this is the cash flow that is going to go to the debt holders. And to the equity holders, the cash flow may come in the form of dividends. In fact, in large corporations, another way in which equity holders make money is in the form of stock repurchases. Again, that's a whole different discussion. The main point here is that when we're trying to measure cash flows, we are trying to calculate free cash flows of an investment, from which then we're saying payments are going to be made to the debt holders and the equity holders. So that is what the notion of cash flow means in the context of capital budgeting decisions. So with this in mind, what I now want to do is emphasize something very, 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 very important, which is that whenever we're thinking about free cash flows or financial cash flows that are going to result from an investment, please understand that the focus is on cash flows and not earnings. There are various reasons why cash flows and earnings are not the same thing, and this is what I want to emphasize in this video. The first reason is that we need to account for capital expenditures. It's a very simple but important point. When we look at earnings or profit is simply, hey, how much money did we make from operations, like sales, minus all the costs. It doesn't account for capital expenditures. Right? So here's an example. Let's suppose that you invested at time period 0 in a van. All right? Let's suppose the van cost you $30,000. And now let's suppose that you use this van for your catering business. And the catering business is great. You're generating a lot of sales, and let's suppose you're expecting to generate a lot of sales in year 1, maybe in year 2, and you subtract the cost and everything. So you have a lot of earnings, okay? You have a lot of earnings, and these earnings are high. Okay, so you're making a lot of, let's suppose that this is a lot of profit. My point is that you can't just look at this set of operations and say, oh, I'm making a lot of profit, this is a great investment. No, you have to account for this money that you spent on capital expenditures. Perhaps more importantly, it is possible that while your operations are yielding a lot of earnings, it is possible that you're having to continually spend on this van. Maybe every year you're having to spend $2,000 in like maintenance capital expenditures. Maybe the tires need replacement. Maybe the body of the van needs work. So you're spending expecting to spend $2,000 in capital expenditures here. Maybe another $3,000 over here. My point is that these earnings that you're looking at, this is purely on the operation side. It is not accounting for capital expenditures. Not only the initial capital expenditure, but also the capital expenditure that you may have during the life of the investment. So that's the first thing. You always have to account for capital expenditure. And perhaps equally importantly, at the end of the useful life of the investment, just like you're depleting cash because of capital expenditures, at the end of its useful life, this piece of equipment, in this case this van, may have some salvage value. In other words, this is something that you can sell the van for in the market at the end of its useful life. Let's suppose like $5,000. Maybe the van is depreciated and now you can only sell it for $5,000. Well, profitability is not helping you account for that. Right? Profit is completely separate. This $5,000, however, you do need to account for as a potential cash inflow that is going to result at the end of this quote-unquote investment that you made in a van. The main point here is that earnings are not the same thing as cash flows. One reason for that is that earnings don't account for capital expenditures. Now, another reason why cash flows and earnings tend not to be the same thing is because the way earnings are calculated, there are certain expenses that we need to adjust for when we are calculating cash flows. So to give you an example, depreciation. Depreciation is what is referred to as a non-cash expense. This is a very, very important point. The reason why depreciation exists is because when we invest in some sort of a long-term asset, let's suppose a van for like $50,000, because the van is going to help us generate cash flows over a long period of time, say multiple years, the IRS basically says, hey, you know what? You're not going to be using this entire $50,000 basically, in 1 year or less. Rather, the use of this $50,000 is going to be spread out over a certain number of years. And so there's a principle in accounting called the matching principle, which basically says that the expenses should be matched with revenue. And so if we're going to be using a portion of the van in year 1, for example, and a certain portion in year 2, then that expense should be specifically in year 1, and that expense should be specifically in year 2, and that expense is basically depreciation. So depreciation is just a way for us to recognize the use of a long-term asset in specific years. It's a manifestation of the matching principle. But please understand that while we deduct depreciation on the income statement to get something like net income, so in this case, this depreciation of $100, even though it says that this is an expense, no actual cash is going out of the business at this point. We're just recognizing the use of an asset that we bought long time ago, not in this year specifically, but some time ago. And so this is just a recognition of that. So that is why when we're calculating or trying to understand the cash flows that we're going to get from an investment, we must account for the non-cash expense nature of the depreciation expense. And another reason why earnings can be different, or net income can be different from an investment's cash flows, is because of interest expense. So a typical income statement will show you that after you've deducted all the operating costs and depreciation, you get something called the earnings before interest and taxes. From that, typically you would subtract the interest expense to get your earnings before taxes, which is essentially your taxable income. And on that, let's suppose that you impose taxes of, like, let's suppose 20%. So this gives you net income. Interest expense is typically deducted to get net income. However, we are interested in how much cash flows that an investment is going to generate. And remember, this is where the idea of free cash flows comes in handy, or because we are trying to understand, how much cash flow will an investment generate that is then free to be distributed to capital providers. And what did we say? We said that one of the capital providers could be something like a bank, and the bank is going to get something like interest payments or principal repayments. What's my point? My point is that when we're trying to measure cash flows, we're trying to measure them as the amount of cash that we have to make something like interest payments or principal repayments. So when we're measuring cash flows, we're not going to account for interest expense in our measure of cash flows, because we, by definition, are trying to find out, how much cash we have from which we can then subsequently make interest payments, right? Because this is the cash that we have free to give to our capital providers like debt holders. There's a deeper reason why we measure cash flows in this manner. When we are looking to estimate the cash flows that an asset or an investment is going to generate, we don't want our estimate to be influenced by how we are going to fund the investment. This is a very, very important point. To give you an example, let's suppose that there are two individuals. So let me erase this. So let's suppose that there are two individuals, A and B, and both are considering opening a restaurant, let's suppose. And they both are looking to open up the exact same restaurant, which means that they have the exact estimate of sales, they have the exact estimate of costs, right? So they have the exact estimate for how much they're going to earn before interest and taxes, okay? The difference is that individual A here is looking to fund most of the assets through debt. And individual B, on the other hand, is looking to fund mostly with equity. So what's going to happen? But while both of them are considering the exact same assets, right, because they're considering the exact same restaurant, they're basically saying, look, our sales are identical, our costs are identical. So the amount of money that we're going to earn from our restaurant before earnings and taxes, that's the same, right? That's, let's suppose, $1,000 for this person, $1,000 for this person, right? But then because individual A is looking to fund a lot of it with interest, or with debt rather, the individual A is going to have a lot of interest expense. And so if this individual ends up saying, oh, this is not a worthwhile asset because it's not going to generate a lot of cash flows for me because there's a lot of interest expense. In other words, because of the high interest expense, individual A comes up with a different estimate of the asset's cash flows compared to individual B, then this is something that is, well, if you think about it, not fair. Because if you think about it, it's the same assets, right? It's the exact same assets. The only thing is that individual A chose to fund them with debt and individual B didn't. We shouldn't let our estimate of an asset's cash flows be influenced by how they are funded. To put this into perspective, imagine individual A walking into a car dealership and the choice is between choosing a Ferrari and a, I don't know, Toyota. And individual A says, oh, Ferrari is not a good car because if I buy the Ferrari, I'm going to have to take a whole lot of debt and I'm going to have to make a whole lot of interest payments. And as a result, I don't like Ferrari. Well, that doesn't change the fact that Ferrari is in fact a superior car to the Toyota, right? It's got better horsepower, better looks, all that. So all those, our point is that the asset's cash flow generating potential should be evaluated in its own right, regardless of how the asset is funded. So, main point, when we're going to try and estimate cash flows, we don't want to account for interest expense because interest is a financing expense, and we don't want to let our financing expense influence our measure of cash flows. So while financing does influence earnings, right, because it influences net income, it shouldn't influence our measure of our cash flows or our free cash flows. Finally, another reason why cash flows and earnings tend not to be the same is because earnings don't account for any investment or any cash that ends up getting tied up in net working capital. So recall, what is net working capital? Net working capital is basically your current assets minus current liabilities. Current assets include your accounts receivable, or your inventory, or cash, and current liabilities. The one we particularly care about is accounts payable. Accounts payable. So this is amount that you owe to your suppliers, for example, over the short term. The main point here is that whenever you make some sort of a long-term investment, okay, so imagine, again, I'm going to take the example of that $50,000 van, $50,000 van that you bought here at time period 0. We said that this was our capital expenditures. That was CapEx, okay? But now let's suppose you bought this van to get your catering business going. This may also involve you amping up your inventory. So you may need to increase your inventory up by, let's suppose, like $1,000. Maybe you need to buy more tomatoes, potatoes, veggies, meat, whatever. Why? Because you're going to be selling, or at least you're hoping to sell more dishes because of your catering business in year 1, right? So during this year 1, you might be looking to make more sales. And look, those higher sales that we talked about and all the costs associated with running those operations, yeah, that is going to reflect in your earnings, sales and costs and all of that, okay? But what those don't account for is the money that ends up getting tied up in something like inventory, okay? So you may have a lot of profit from your operations, but you also may have a lot of money tied up in inventory. And yes, granted, when you bought this $1,000 worth of inventory, as you made those sales, yeah, inventory went down. But then what happened? You went out there, shopped for inventory all over again. Because why? So by the end of year 1, for example, you may actually have inventory of $2,000. Why? Because you used up the inventory at the beginning of the project, which is $1,000, to support your operations in the first year. And at the end of the first year, yeah, you generated a lot of profit, you made a lot of sales, had a lot of costs, right? So you may have a lot of earnings here, right? You may have a lot of earnings by the end of year one, but you also have a lot of money now additionally tied up in inventory, $2,000. Why? Because this is going to help you go through year two operations, right? You're not done with the project. So this is a very, very important point, actually, that money that is tied up in net working capital at the end of a particular year is there because it's going to help you support. It's basically going to help support operations going forward, like inventory. Okay. At the end of year two, again, you may have even additional inventory, say $3,000. Okay. I'm just taking the example of one current asset like inventory over here. The main point is this: at the end of each year, at the beginning, you had $1,000 tied up in net working capital in the form of inventory. That went up from $1,000 to $2,000. So now you have an extra $1,000 tied up. And then at the end of year three, you have an extra $1,000 tied up. So these changes in net working capital, right, which is basically the changes in inventory in this case, is basically representing how much additional cash you are bleeding, right, as a result of keeping the operations going. Okay, so changes in net working capital, here's the punchline. All these changes, this delta sign is for changes. All these changes in net working capital represent investment essentially in short-term assets. Investment in short-term assets, right? So just like capital expenditures are your cash outflows associated with making long-term investments, you can think of changes in net working capital as representing your investment in short-term assets. Why short-term? Because inventory in a very short period of time is eventually going to translate into cost of goods sold because you're going to make a sale. The point is that that's not the end of it. Even though inventory goes up and then goes down, you have to go back out there and get inventory all over again. In fact, this brings me to a third and very, very important point, which is this: that if by the end of some time period, let's suppose 5 years, if you're looking to get done with the project, okay, if you're like, look, I'm only going to run this project for like 5 years and then I'm done, then by the end of 5 years, do you need any more inventory? You probably answered no. Why? Because why did we pile up inventory at the end of year two or year three? Because inventory at the end of year two helps us move forward into year three, right? Because it helps with operations. At the end of year three, we had some inventory. Why? Because we want to support operations going forward. By the end of year five, we are not looking to spend any more in inventory, right? Because we're not going to go beyond year five. So we're not going to be buying any more stuff here. What does that mean? That means that net working capital by the end of the project's life basically drops to zero. So while I had $1,000 and then $2,000 and then $3,000, so on and so forth, tied up in net working capital, which is inventory, by the end of the life of the project, net working capital will go down to zero. And this is important because then this means that any money that was tied up in net working capital during the life of the investment, that gets freed up. Imagine that you were running a jewelry store, okay? And you had all like $500,000 worth of jewelry that was tied up in inventory. Why? Because with jewelry stores, we know that they have to display all these earrings and necklaces and all these different things on these shelves. And so even when somebody goes and buys something, they always sort of replace it with another piece. And so if the jewelry store expands its operations as it's selling more, it's showing more and more stuff on display, a lot of the money is tied up in all this inventory. But imagine now as the jewelry store operator, then you say, hey, you know what? This is the last year. This is the last year in which I'm going to be running operations. What does that mean? This means that during that year, if somebody comes in and buys a piece of necklace or some earrings, do you go out there and replace it? No, right? You're just letting your inventory run, right? Because you're not looking to continue with these operations. And so that is why typically at the end of the life of the investment, all the net working capital basically goes down to zero. This is not only true for inventory, even account receivable. If you were extending credit to your customers, once they pay, you're not going to make another repeat sale to them, right? You're not going to generate another accounts receivable. You're done. So all the money that was tied up in net working capital, you end up recovering. Keeping all of that in mind, then, the way in which we can measure cash flows, or as I've said, something that we also refer to as financial cash flows. So this is the equation that you will see very, very frequently. We say, hey, the cash flows that we are going to get from an investment is the earnings before interest and taxes. So this is essentially sales minus all the costs. And we separately account for depreciation because depreciation is a non-cash cost or a non-cash expense. So when I say costs, these are all cash costs. That's what I'm referring to. So costs and depreciation, technically they're both costs, but the difference is that these are all cash costs. Depreciation is a non-cash cost or a non-cash expense. So the difference between all of this is earnings before interest and taxes. So notice the first thing that we're doing is that we're saying, hey, okay, let's first figure out, how much of the earnings before interest and taxes are we going to get to keep after we've paid taxes. So T represents here the tax rate. If the tax rate is something like 21%, this means that 89% of the earnings before interest and taxes is what we're getting from operations. What I want you to note is that we are looking at the earnings before interest. This is the point that I made previously also, that we are interested in how much the project or the asset earns before interest. Why? Because we don't want to taint our measure of the cash flow generating potential of the asset by how it's funded. So we want to look at earnings before interest, not after. So that's the first thing. The other thing that you will notice here is that depreciation is being added back. Why? Because depreciation, like we said, is a non-cash expense. And when we subtract depreciation, technically no cash is going out. So technically we are generating more cash compared to what our earnings before interest and taxes is telling us. So that is why we add back depreciation. Now, some of you might be looking and saying, wait, why are we first subtracting depreciation to get EBIT and then adding it back? The reason is simple, because depreciation helps us reduce our tax liabilities. The higher is going to be the depreciation, the lower is going to be the earnings before interest and taxes. And the lower the earnings before interest and taxes is, when we'll multiply that by our 21% tax rate, that's going to result in a lower tax liability, right? And then we are adding back the depreciation. So the benefit is that depreciation helps us reduce our tax liability. So depreciation is important in that respect. The other thing that you will notice here is that once we do all this math, and by the way, this is also known as the operating cash flow from an investment. So this is typically how you're looking to make most of your money or most of the cash from an investment, is through operating cash flow, right? In fact, that is why you spend all the money initially in capital expenditures, and this is why you invest a lot of money in your net working capital. So CapEx represents cash outflow associated with long-term investment. So long-term investments, and changes in net working capital here you can think of as investment in short-term assets like inventory and account receivable. Notice that this equation very neatly captures all the different ideas that I've presented to you earlier, which is A, depreciation is a non-cash expense, so we need to account for the fact that our cash flow can actually be higher compared to what earnings are suggesting. Interest expense is a financing expense, so technically we shouldn't let that influence our measure of cash flows. Third, that we should always account for any cash flow that we are depleting because of capital expenditures. And fourth, then any cash that gets tied up in net working capital that also should influence our measure of cash flows. And so that is represented here. And so this equation is very often used to estimate the cash flows that result from an investment. Oftentimes, you will see this represented as operating cash flow minus capex minus change in net working capital. But now you know that operating cash flow is essentially this entire portion. And so this then is an introduction to how you can go about thinking about estimating the cash flows from any project or investment. In subsequent videos, I'm going to show you how you can implement this to evaluate whether an investment is worthwhile or not.